Hey y'all, Austin Baker here with
Hugh Hartzog.
and we are back with the next installment of Hugh Knows. Hugh, what's on the agenda for today?
Great. So today we had the CPI data come out for March. So we're going to look at what that means for the mortgage market and for real estate. And we're going to look at the broader macroeconomic context, which we typically do on each of these episodes. We'll then take a little bit deeper dive into some Houston relevant data and sink our teeth into that. And then we'll end with a summary and an overview.
I love it because here on the Hugh Knows podcast and video, we're all about breaking down how interest rates are national, but the real estate market is local. That's why we do the show. And before we jump into the show, we want to remind you guys that everything we say on this is our own personal opinions, does not reflect the opinions of our parent company, Network Funding. Also, we are not giving you investment advice. We are just simply looking at the data and giving you our opinions and how we think it could be impacting the mortgage industry as well as the local real estate market. So I'm super excited about today's show, Hugh, and talking about the CPI report, which is a big indicator on how inflation's doing. And we all know, if you've been paying attention, that inflation is what drives what the Fed is doing. What the Fed is doing drives how mortgage rates are doing. So this is a very important data point for us to pay attention to. So let's take a look at it.
Yeah, so jumping into that first slide, looking at the CPI data. So CPI data came out this morning, and the overall numbers showed that on a year-over-year basis, inflation continued to ease, meaning that it came down.
Yes.
So it was at 5%, looking at March 2023 versus March 2022. That beat expectations. Most economists were not expecting it to fall that low this month, and so really good news on that front. There was some concerning news, which is there's different measures of the CPI. So one thing that they do is they'll look at the CPI without food and energy, and this is called core CPI. And the Fed and markets are looking at this measure very closely. And unfortunately, that measure did tick up ever so slightly in the month of March. So on display right now, I'm showing the CPI in the blue line and the core CPI in the green line, and basically you can see the overall CPI number, so inflation, that inflation measure has come down, and we've seen that almost steadily decrease since the middle of last year. But that core CPI number is a little bit more buoyant, and it did see a little bit of an increase. But overall, this is great news for the mortgage market. We're continuing to need to see inflation come down, and so seeing that overall number come down is definitely a positive sign.
Yeah, that's awesome. So I've got a couple of quick questions for you. Looking at this slide, Hugh. So when we first, the blue line, that's the core, or that's the CPI. Is that including core, or has core been removed from those data points?
No, the blue line includes
core. Okay, so if we backed out core, it's falling even more than that. So this is really a strong indicator. This is one of the things that the Fed has been looking for, what the market's looking for. So even though core has been stubbornly high and, like you said, buoyant, resisting, coming down, man, the rest of everything else that we're looking at from an inflationary standpoint is even stronger than what this blue chart shows. So that's super encouraging. Talk to me about why is core staying up?
One of the main reasons that core is staying higher is because of shelter costs being high. And basically that reflects the fact that, you know, the cost of shelter has continued to rise over the last 12 months.
And by shelter, we're talking apartment.
We're talking about all shelters, so not only housing, so people owning housing, but also apartment renting, leases, and that sort of thing. So all shelter costs, and those have increased. But we should start to see shelter costs start to decrease in the later part of Q2.
Right, we're hearing rumors of all that.
That's right, and the reason for that is because leases, which are a part of shelter costs, typically are a year long. And it was last year about this time that we were really starting to see the rental market heat up,
right?
Because interest rates were rising, and so that was forcing people out of buying houses and towards renting, and that rose rent costs. So now that we're a year on, in the months of April, May, and June, we should start to see shelter costs come down, and that should bring the core CPI number lower, which would be great.
Which makes sense. I mean, that's one of those things that we're spending a little bit more time on this slide, but that's a lagging data point.
Yeah,
right?
It's a lagging
because
indicator.
Leases are a year long, and so it makes sense, and it should be expected that the core data points should be somewhat delayed from where the rest of the CPI data is going. Overall, guys, this is huge news today. I think this is kind of why the market was a little, bearish heading into it, is because they're anticipating the core probably hadn't fallen as much or at all yet, which is true. It hasn't. It's actually ticked up slightly, but overall, total CPI came out. It's actually beating expectations. So it's going to be interesting to see how the mortgage market reacts to this.
Yeah, absolutely. So on this next slide, we'll keep on talking about sort of the macro economy. And obviously what Austin just said is that inflation impacts what the Fed is doing, and obviously what the Fed does impacts mortgage rates. So on display on this.
It's the circle of life.
Yeah, it's a circle of life, that's right. And so on display right here, what I have, I'm showing two data series. The first is the federal funds rate, which is the projection from the Fed's what they call the dot plot, showing what the Fed is expecting interest rates to be for their federal funds rate over the next year and a half. And then the dark blue line shows what the market is expecting federal interest rates are going to be.
Right.
And so what you can see is basically the market is expecting interest rates to be lower than what the Fed currently is projecting.
Yeah.
Which is a very interesting fact.
Yeah, there's a couple of things going on there, right? The market is somewhat calling the Fed's bluff, but I think even more true than that is that, and we always talk about this, the market is always trying to anticipate what the Fed is going to do. And so that's why whenever the Fed does their rate hikes, you don't see mortgage rates typically spike that day. It's like we're anticipating what the Fed's going to do. So that's getting baked into the pricing well in advance. And so what you're seeing here on this chart is the Fed saying, hey, we're not planning on lowering rates this year, right? We kind of know that. We're planning on, it looks like the Fed's almost done raising rates. So we're looking at stability for the rest of the year, at least from what the Fed is plotting out and anticipating. And then you see that it starts to drop right at the end of the year, beginning of next year, as far as the Fed's expectations. Well, the market, look at what the market's doing. The market is kind of already almost in line with where that drop is, but we're starting to see a gradual improvement. So that's what we've been telling everybody, is we think that as the Fed, this backs up our theory from the last few months, that once the Fed gets to this leveling off point, we're going to see mortgage rates and everything else, we're going to see the market start to improve for us. And then obviously, after they do start to drop their rate at the Fed level, we're going to see rates continue to drop. And that's why we're so bullish on buying right now and being able to refinance in the next 1 to 2 years. Who knows what could happen in the world, right, Hugh?
Right.
But as far as this data point is concerned, if things go the way that we're anticipating, this is where we're getting that theory from, that we should be able to refinance people next year, hopefully.
Yeah, I mean, I think that's a strong case to be made that even if you have a high rate now, if you're able to get the house, and then in the next 24 months you'll be able to refinance. And I think that's borne out by this data, both what the market is expecting and what the Fed itself is saying.
Yeah, and one side note, real quick, with this going on, this means that you're going to lock into an interest rate, and most likely by the time you close, the market has improved. But you're not going to be able to slide down when that happens. When you lock in an interest rate, that is secured. And so your gut might be to feel bummed out that interest rates got better while you were under contract before you closed and you weren't able to take advantage of that. But really your mindset should be the opposite. You want to see that rates are going down, because that is showing that you're going to be able to refinance, right? When rates go up, people feel good, like, oh man, I'm so glad I locked in when I did, because look, rates got worse. But that's not really what you want to see if you're a smart, non-emotional buyer right now. You want to go, okay, I locked in, and I want to see that rates are continuing to improve, and this is our target range, guys. We're looking at 2024 and beyond as that beautiful window for hopefully being able to refinance.
Yep, absolutely. All right, so on this next slide, we're going to look at what the market has been expecting as far as what the Fed is going to do. And this is looking at the expectations at different points in time. Mm-hmm. Okay, so I have basically the expectations of what the Fed is going to do from the market a month ago, 1 week ago, and as of today. Okay.
So what happened in the news?
So what happened in the news? And we talked about this on the last episode, but basically, a month ago, the Silicon Valley Bank fiasco had not occurred, right? And so once that occurred, markets started to say, okay, there's systemic financial risk that the Fed now needs to take into account. of when they're creating their interest rate policy, and so they're likely not to increase rates as much as they were going to,
Right.
or not increase them at all because of this risk. And so the market a week ago and as of today is pricing in a lower federal funds rate over the next couple of years because they see that extra risk. And that's basically reflected, as you can see, from the red line. It moves down to the orange or yellow line, and then we're slightly above that yellow line as of yesterday. But basically a lot lower than we were a month ago as far as what the market is expecting, because again we have these risks pop up.
I think this is such a fun slide. So when you're looking at this, red line is pre-Silicon Valley Bank collapse. Yellow line is not too far after the collapse. Everything's like, whoa, things are actually, they should improve faster. But really, this has just been a pendulum, you know? And so it's like, okay, the reality is somewhere, as it often is, somewhere in the middle, you know? And so that's where the blue line is. And I think that blue line is healthy. That's kind of what we anticipated. It seemed like the SVB reaction was a little bit of an overreaction. Also, fear. We didn't know how many banks were going to domino from that at first. And
unknowns.
So a lot of unknowns. When that happens, things get crazy. Now that we're starting to see the landscape, things are kind of coming back to a reality that, hey, yeah, the Fed raising their rates is definitely causing stress on some of these banks. But it's not like we're looking at a total collapse.
Yeah, it doesn't seem that way right now. But of course, I mean, like when it first happened, you had the SVB bank, and then there was this other bank that that failed as well, and then you had the Credit Suisse issue in Europe. So it seemed like it was spreading. And so that's probably why you've seen a little bit higher rates now expected versus a week ago, because those risks have started to wane. But certainly the blue line is basically, I'd say, in line with, you know, risks that are coming from the financial sector, but also the fact that we are seeing decreasing inflation.
Right.
And that's a great thing.
Yeah, it's a little bit of a combo there.
Yeah,
so
absolutely.
It's a great slide.
Yeah. Okay, so let's move on to this next section, looking at the Houston area analysis. And on this next slide, what I'm showing is the population, total population for Houston since 1970. And this is the axis is in millions, so we're almost up to 5 million people in Harris County.
Crazy.
Last year, Harris County was number 2 for population growth out of all counties in the United States. I think Maricopa County in Arizona is the only one that beat us out. So out of all counties, Harris County, where Houston's located, added the most people, which is good news, I guess, for the broader Houston economy.
Yep.
But there are also implications for real estate and mortgages as well.
Absolutely. And so what this chart doesn't show is the uptick from last year, right? Like we're ending in January of 2022 on this. And so, and the piece that has yet to be added is what's coming in as the number 2 county in the United States for growth. So people are continuing to flock to Houston. We have such great diversity with jobs. We've looked at, you know, how the S&P 500 companies that are headquartered in Houston are beating the rest of the S&P 500 handedly. And so there's a lot of good economic drivers. There's also the political landscape. There's a lot of things. Weather is probably not one of them. There's a lot of other things that are driving people to move to Texas. It's, you know,
yeah, it's good.
Land of the free and the home of the brave.
That's right, and I mean this signals, you know, long-term on a long-term basis increased demand for real estate for Houston. Mm-hmm. Obviously, a good thing for realtors and for those in the mortgage market. So very excited to see this, and this basically follows on from the data that we had showed a couple of episodes ago, showing that Texas was the number 2 state to add the most people in 2022. Florida was the only state that beat Texas as far as number of net new residents added. So just on a long-term basis, we're adding people, which is good for the economy and good for real estate.
Yep. So Houston is a good place to be if you're going to be in the real estate industry.
Absolutely.
All
right. So moving on to this next slide, we want to just recap on what's going on with inventory in the Houston market. And we've talked about this almost on every episode, but it's a huge factor right now, and it really is driving a lot of the market. So what I have is a screenshot from ATR.com from yesterday showing the months of inventory currently in Harris County. And right now we have about 2.1 months of inventory. That's lower than it was back in in January and February of this year. It was around 2.5, 2.6. So we've decreased the number of inventory, the amount of inventory, and that is even though more houses are coming onto the market, which is basically signaling that there's some pent up demand. There's some pent up demand because houses weren't on the market. There were people that were looking. They've been looking, and now the houses are starting to come on the market. They're sweeping up really quickly. We're seeing that, and just in the borrowers that we're dealing with, they're in multiple offer situations. They're having to be aggressive on their offer strategies, and there's just not a lot of inventory around. The neutral point is that 6 months of housing inventory. So we're a third of that right now.
Right.
So very tight market, and we think that's going to keep prices buoyant. It's going to keep the market competitive, especially in Q2.
Yeah, this is what we were trying to warn everybody about last year, right? When there was a little bit more inventory, not much more, but there was the kind of shift in the mindset that it was like, hey, it's not technically a buyer's market, but there's some indicators that are giving buyers a little bit more advantage than they had earlier in the year last year. We were warning about this. We were saying, hey, there's so much pent-up demand that as we get into next year, people will get used to where the interest rates are. Interest rates will start to gradually improve, and as they improve, even more people are going to be coming in to the market. And so that's what we've got. There is so much pent-up demand. We looked at how many people are moving to Houston, and specifically Harris County. And this is exactly what we literally told people, hey, if you enjoy multiple offer situations and having to go thousands and thousands and thousands of dollars above the list price, wait to buy the spring, and here we are. And it's just wild to see, even though we knew it was going to happen, sometimes it's still crazy to actually see it. But to see that inventory is dropping, even though more houses are coming on the market, man, there's just so many more people that are trying to buy it. And frankly, Hugh, I don't see this getting better. I think that as interest rates come down, we could very easily dip below 2 months. Things are going to get really expensive on the home buying front.
Yeah, I mean, again, what we've talked about in the past, what really will drive inventory in the short term is foreclosure rates. And we've gone through that data a lot, saying that we do not think that foreclosures, particularly in Houston, but even nationwide, are about to rapidly increase, which will really drive that inventory. You don't have a ton of new builds coming on. I mean, there are out there, but we're short on a long-term basis on housing. And we have new people coming to the state, to the Houston area. So we're increasing the demand. The inventory is not likely to change because you're not about to see foreclosures increase. And so we don't think that this inventory situation is really going to resolve itself. And so we're expecting, like I said, to see a competitive Q2. Maybe the volume's lower than it was last year, but it's still going to be a competitive market out there because of this low inventory situation. And because, again, versus November, rates have come down 100 bips. And so people are sort of psychologically settled into this new interest rate regime. And once interest rates start to decline, they feel comfortable, as long as they can afford it, and jump back into the market.
Yeah, absolutely. So I think this is really the story, guys. If you're looking to buy, if you're a realtor, inventory is the issue. And as inventory gets tighter, home prices continue to rise. And one of the problems we're seeing just professionally and very locally is more than ever in my entire career, I am seeing people that are buying their next house, not selling their departing residence there because their interest rate is so low, they have so much equity. They're all saying it'd be crazy for me to sell. And so they're renting it out. That's exasperating the problem.
Absolutely.
And we're seeing it over and over. Every day we're seeing it where people are coming in with the mindset that they're going to buy and not sell their departing residence. And so that is just, like I said, further exasperating this inventory shortage that we have. Hugh, I don't see inventory not being a problem in the Houston area literally for quite some time. As rates start to improve, it's only going to get worse. And so if you're thinking about buying, I can't stress enough, it is going to be so much cheaper for you to buy now with interest rates elevated and refinance in a year than it is for you to sit on the sidelines and wait a year for interest rates to come down, your house is going to cost, that same house, you might not be able to afford it because it could easily be $50,000 to $100,000 more.
And the interest rate might be, 100 bips lower in a year, but because the price of the house has gone up so high because it gets competitive, then you're forced from the affordability perspective, you're not able to get into the market.
That's right. And one of our favorite sayings is that interest rates are interesting. So many people get hung up on the interest rate percentage. What buyers should be focused on is they should be focused on monthly payments.
Yep.
They should be focused on cash to close. Of course, the interest rate impacts that, but so many people are shocked that it only impacts it as much as it does.
Right.
People are pleasantly surprised when they find out, oh, the monthly payment's only that, I can afford that. So realtors, I would be talking to your clients not about what interest rates are, but about monthly payment and getting people focused on that. Can they afford it? Because the affordability of that house is going to run away from them as interest rates improve.
Absolutely. Good point. All right, so just moving on to our summary and overview. A couple of key points that we want to leave y'all with. So first of all, inflation has come down, which is great news. The core CPI is a little stubbornly high, but with shelter costs expected to come down in the next couple of months, we should see that core number come down as well, which would be positive for mortgage interest rates. There was obviously some stress on the global financial system because of the collapse of the different banks in the U.S. and the issues with Credit Suisse, and that could cause the Federal Reserve to rethink its interest rate policy, maybe pause interest rates.
Right.
And the market's sort of evenly split between a pause and a 0.25% increase right now. Harris County, second in the United States for population growth in 2022, which is tremendous news. And then, as we just said, inventory remains constrained nationally, but especially in Houston. And we think that's going to be a primary driver of the market going forward. So we appreciate y'all tuning in to this episode of Hugh Knows, and check us out next time.
That's right. Like it, share it. We'll see you guys around. Adios.